Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into a key report from Goldman Sachs Global Investment Research. It's titled, Diesel Margins to Moderate, but Remain Above Pre-Pandemic Averages. And it just came out July 24th, 2025. Our goal here is to really understand why Goldman sees diesel margins staying so high, well above the historical norms.
Exactly. And this report, it lays out the drivers behind the recent diesel margin surge quite clearly. It gives updated forecasts for U.S. heating oil and European gas oil.
Mhm.
And importantly, it looks at the risks, emphasizing this, well, persistent structural tightness in global refining capacity. That's a key theme.
Right, structural tightness. So let's start with what triggered the rally in the first place. What were the main drivers?
Well, Goldman points to three core factors. First off, you had unexpected refinery outages, particularly in Europe. That, combined with refinery closures happening faster globally, pushed total outages to a four-year high. So refiners basically had to prioritize gasoline. It's, less complex to produce.
Okay, that makes sense. Less complex. What was the second factor?
The second one is China. Their diesel production in the first half of the year was down about 0.3 million barrels a day compared to last year. It's tied to a government policy shift, really, pushing towards petrochemicals instead of fuels. So converting more crude into things like plastics, fertilizers, less diesel for the globe market.
I see. So less supply coming out of China. And the third driver.
The third piece is about the crude itself. We saw lower exports of heavy and medium crude, think Venezuela sanctions, Canadian wildfires, things like that. This meant refineries were getting more light crude, and making diesel from light crude, it's more complex, requires more intensive processing.
More intensive processing.
Right.
Okay, so those factors paint a picture of pretty tight supply. How does this translate into Goldman's updated forecasts for margins?
Well, they're projecting diesel margins to stay about $10 per barrel higher than the 2013 to 2019 average. And that's for the rest of 2025 and through 2026. Specifically, for the second half of 2025, they've actually upgraded NY Harbor heating oil to 28 DATS a barrel and Europe gas oil to 23 trials.
Upgraded. Okay, why the continued strength?
It's largely because new global refining capacity isn't coming online fast enough. Additions are slowing down significantly. We're going from maybe 1.2 million barrels per day added in 23-24 down to just 0.5 million barrels per day expected in 25-26. That keeps things tight. For 2026, they see NY Harbor maybe nudging down slightly to $24, Europe gas oil at $18. Still very strong historically.
So drilling down on that a bit, why exactly are these high margins expected to persist for so long? What's the core reason?
It really boils down to that structural refining capacity issue we mentioned. There just isn't much spare capacity globally. Plus, you have China's strategic shift toward petrochemicals. It's not a short-term blip. It seems to be a longer-term policy. And as we said, the lighter crude slate makes producing diesel inherently more complex and costly. It all supports higher margins.
Okay, that makes sense. Now, you mentioned regional forecasts differ U.S. versus Europe. What's driving those differences, and how does seasonality play into it?
Yeah, the U.S. margins get an extra lift from higher RINs prices. Those are the renewable identification numbers, the credits for blending renewables. They effectively act like a premium on U.S. diesel prices compared to, say, Europe. Seasonally, you always get strong U.S. diesel demand in Q4 thing harvesting, building heating oil stocks for winter. That requires refiners to run harder and restock, which gives specific support to U.S. heating oil margins then.
Got it. So RNs and seasonal demand boost the U.S. side. Lastly, what about risks? What could knock these forecasts off course, and what's the advice for refiners?
Sure. On the upside for margins, you could see even faster refinery closures in developed countries, or maybe delays in new capacity coming online in emerging markets. That would tighten supply further. The main downside risk. Demand weakness, particularly a potential U.S. recession, would definitely hit demand. Goldman's observation is that future prices, the deferred margins, are actually trading above even their bullish forecasts right now. So their recommendation is pretty clear. Refiners should consider hedging. Lock in those future profits now while the forward pricing looks attractive.
Hedging those deferred margins. Okay. It certainly seems like these twin forces, refining constraints and major policy shifts like China's, are going to be key factors shaping commodity markets for some time. Definitely something for you, our listeners, to keep a close eye on.